Hi, this is Sheldon here from the Currency Advisory Desk. Well, we are at the fag end of a very crucial financial week. Yesterday, the all important Fed decided to extend the Operation Twist till the end of this calendar year. So this Operation Twist will continue, wherein they will purchase long-term securities and sell off the short-term securities. And they will probably it's to get in more liquidity in the market and to give a sense of confidence to investors towards the long-term outlook of the US economy, that is. Now, though this was supposed to have the effect of a sweetener on markets, we witnessed a muted and pessimistic movement in world markets. Now, this was mainly due to the comments from FOMC, the Federal Open Markets Committee, after the information was out that the US GDP growth will slow down and unemployment rate will increase. This is negative for the US economy, and hence we saw the very muted response to this measure taken by the FOMC. Now the dollar is expected to move higher against the rupee, and we also witnessed that the US dollar index is at around 81.77, which is marginally up by around 0.21%. US unemployment claims, the data which is due today, is expected to come lower at around 381,000. Along with they also have the flash purchase managers index data. We also have some existing home sales data. Now this data is very important because it is a leading indicator, which means that it is reported for the previous month, but it's reported in an annualized format, which means it's multiplied by 12 when reported. And this has a leading indicator effect because it triggers a lot of other things in the market, like people spend on home renovation, then the sale of mortgage by financing banks, and also the payment of brokerage. So this particular data gives us a sense of what is going to happen in the future. Now, one more important comment, what is important phenomenon that's going on right now in the US is the fiscal cliff that everybody is talking about. The fiscal cliff is nothing but on December 31st, the tax cuts which have been passed during the administration of George W. Bush will expire, and also the payroll tax reductions which were introduced during the administration of Barack Obama will also expire. And on Jan 1st, the federal spending cuts approved as part of debt ceiling will take effect. So basically, whatever incentives have been given to citizens of United States, that will in the form of fiscal policies, in the form of taxation, that will come to an end, and you could say the US will move towards more austerity as such. So this will cause a huge cliff, as in this will cause probably a huge movement of the US incomes, or the movement of US investment will stop. So this is what everybody has been talking and warning about, and what we see is that the effects of this will start to come probably not till the year end, but probably by October or September. We will see companies not going for hiring. We will see not much of expansion in US. And this will have a very adverse effect on the US dollar and the US securities as such. So that is one thing what we have to keep in mind whenever we are deciding a long-term strategy towards our currency trading. Now today we have the Germany's manufacturing PMI, and we are expecting it to contract because even though Germany has been outperforming in the Eurozone, with the recent numbers that have come out with which is so disappointing, we are not expecting any sort of expansion in this particular data. Also in the UK we have the retail sales data. Now the retail sales is forecasted to be at around 1.1%, which is an improvement over last reported number of minus 2.3%. Even though this is an improvement, what we can see is that the pound, the Bank of England is sort of in a dilemma because it cannot go ahead and reduce any interest rates or boost the currency in any manner because of the inflation levels that are persisting there. The economy is similar to Indian economy, and we are facing similar concerns, wherein if we reduce the rate of interest, if we pump in more money, there will definitely be more inflation that is going to be an outcome of this particular pumping of the money. So we maintain that our bearish look on pound versus euro, we maintain that outlook. Moving to the euro hit an intraday high of 1.2708 against the dollar But however, we saw that it gave up its gains very fast. This was basically due to the after effects of the FOMC meeting, and it's now trading at around 1.2668. The increasing yields of Spanish and Italian bonds puts a lot of pressure on the euro. We have one event which is coming up on July 5th, which is the ECB meeting. Now, this is a bit important for the euro because they will be deciding on whether they should go in for further rate cuts, and this will have a major effect on the euro. So we expect till July 5th the euro will be very volatile basis this event that is there. Now we advise a sell call in the euro rupee pair. Moving to Japan. Now in April, Japan's exports increased by 10% year on year after a 7.9% increase in May, that is, and 5.9% pace in March. Now, after preliminary data released by the Ministry of Finance, it showed that imports over the first 20 days of May actually contracted by a little more than 1%. Now, increasing trade deficits may put further pressure on the Bank of Japan to devalue the yen, because as we know that any trade deficit is harmful for the country's growth. So the increase in imports, particularly energy imports that we are witnessing recently in Japan, it signals towards a more internal demand driven recovery. So this is, in a sense, it's positive for the yen, and hence we expect the yen to further strengthen and recommend buying at these particular levels, because we see that the Japanese economy is moving towards more the outcome is more predictable, and the confidence in Japan is increasing post whatever the tsunami and everything that took place. So we are bullish on the yen, and we recommend a strong buy on the yen at present. Well, that's it for today. Thank you.